So here we go. This is my price target for Bank of America. This is based on two different valuation methodologies. The first is a price to book value methodology, and the second is a discounted earnings per share valuation. So what do I think Bank of America stock should be selling for right now? Keep watching and find out. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence. What's up everyone? My name's Robbie. This is Robbie in Manila. And today we're doing a stock analysis of Bank of America. Thanks to everyone for the poll that I posted. And you voted on doing a bank stock for the next video. So we are doing a bank stock today, Bank of America. This one over Intel, Alibaba, Facebook, and Apple. So that's what we're doing today, Bank of America. Now I know a lot of you that are watching this video are very much into dividend investing. So that's where we always start off with dividend paying stocks. So first off, we have some dividend metrics. This company has paid a dividend for 8 years. It's increased its dividend for 8 years. The dividend yield currently is 2.06%. Not a huge dividend yield, but it's above that 2% threshold. So over 2% is usually decent for a dividend, and then the growth rate is 13%. Now, the way I look at this is a bit different for this company because if you look at the past 3 years, yes, it's 13%, but actually over the past 5 years, this company has grown its dividend 25%. Over the past 9 years, it's grown it almost 40%. So this company grows its dividend quite a lot. Now, this other section of the spreadsheet, which I usually have in non-bank stocks, is the free cash flow payout ratio, but because this is a bank stock, we don't use free cash flow to look at the payout ratio. We use earnings. So actually the earnings, the payout ratio based on earnings is around like 22% for Bank of America. Not very high actually, so I'm happy with that payout ratio. I'm actually not doing a dividend discount model valuation on this company, so we're gonna move on to figure out the price based on the price to book value. So here we go, jumping right into my price target based on the price to book valuation. So this is a $38 price target for this year, 2022. Now this would equal a negative 7.65% rate of return if this were to occur. Now the 2026 price target is $44, which would be a return over that period, an annual rate of return of 1.64%. So not a great return, of course, for this company right now where it sits using a price to book valuation. Now, there is another valuation methodology we're going to use in a few, so let's see how that shows because there is actually quite a big difference in these two. I'll tell you that right now. But quickly, let's look at the price to book valuation and some of the inputs that I used. So the first step that I always have is I try to find the shares outstanding and I forecast them. So what I did was I said, well, the median share increase or decrease over the past multiple different years has been about negative 3.94%, and that's the median, and then the average is 4, so they're very close. Now, because there's actually some excess debt in this company compared to its peers, I lowered this a bit because I think that debt may have a little bit of an impact on how much it buys back in the future. So I used negative 2.5% in share buyback, so they're buying back 2.5% every year going over the next 6 years. Then step 2 is the book value forecast. So what I do here is I say, okay, the median book value growth, I look at that, and over the past few years, 10 years or so, 9 years or so, it's been 1.5%, and the average is 1.6%. So those are close, so I like that. That gives me more confidence. The highest it's been over the past year, 2.9% growth, so a lot higher than the median. But it's also been over the past 3 years, 0.49% growth. Of course, there was a pandemic in that period. So let's move on and see what I use. So I use 1.5%. That's the median. So I have a price to book. I have the book value per share growing at 1.5% over this time period. Then I have step 3, which is the multiple that we're going to use for this valuation. So we're going to use a multiple based on the median. So the median is 1.24. So the price to book over the past 2017 is 1.24. In 2018, at the end of the year, it was 0.98. Then it was 1.29. So these are the ranges that it usually sits within. So these are the numbers. And then this is what I'm using. So I'm using the median, which is a bit higher than the average. And the current price to sales is actually 1.37, so I'm using less than the current price to sales multiple. So what do we have? We have down here 1.25 is what I'm using, and this gives us 2022 a price target of $37.77. That's negative 7.49%. So that's what I'm getting. Now, this grows until 2026, like I said, to about $44.36, about a 1.67% rate of return. Now, remember, I always say pick your flavor here. So if you want a lower price to book than I'm using, you can use these numbers. If you want a higher, you can use these two different numbers. So that's up to you. If you don't like the numbers that I used here, you can always do that. Okay, so next up, let's compare the different big banks to each other. Now, usually I go through my Cat 5 score, which is a score that I created for companies. Now, I don't use Cat 5 score on banks because they are judged by different metrics. So I have my own little thing here. But we're going to go through these different comparisons of some of the banks, just some of the ratios. And remember, by the end of this, we're going to do the technical analysis of this stock as well. So JP Morgan is a PE of 8.82, and then Bank of America has a PE of 11.46, the highest PE of all of these different banks. And by the way, so this is JP Morgan, Bank of America, Citi, US Bank, and Wells Fargo. And if you look over here at the market cap, you can see which are the biggest banks. So Bank of America is the second largest of these. JP Morgan is the largest. So while JP Morgan had an 8.82 PE, the forward PE is actually higher than Bank of America's. So Bank of America is slightly lower at 10.63. And then the price to book is actually a lot lower for Bank of America. And then we have earnings per share growth. So what do we want to see? Well, we want to see if this thing is growing earnings per share higher than some of the other banks. And it is. It's doing better over the past year, at least, than JP Morgan. And then over the past 5 years, it's actually had very great growth at 19%, pretty much equal to JP Morgan and higher than these other banks. But there is one thing about this. There's a little bit more debt for Bank of America, which a 2.02 is the debt to equity ratio, while JP Morgan only has 1.16, and these other banks have a lot lower. So what I'm thinking here is that this debt load is maybe going to have a bit of a drag on the company comparatively, at least to, like, let's say JP Morgan. And then on the bottom here, you can see the averages of these different numbers and the medians if you want to take a look at that. So what do I, generally, what do I see? Well, I think, a little bit higher debt for this company, but earnings per share is good. The forward PE is a little bit lower than JP Morgan's, and the price to book's lower. So, valuation-wise, this thing is probably like in the middle, I would say. This is the thing I'm focusing on, is this debt to equity ratio right now. So lastly, before we get to our actual price target, we're going to do a valuation using earnings per share. So I'm on gurufocus.com here. And so I have some different inputs for this. I have a discount rate of 9%. And I'm using a growth rate of 10%. So if you look over here, you'll see that earnings per share is 50% over the past 10 years, which is crazy. Over the past 5 years, it's 15%, so of course a lot lower. And then over the past year, it's up pretty high. So when I looked back and I did some calculations of the different growth rates, the median growth rate during the whole 10-year period is actually 13%. But that does have the pandemic in there, so 13%, and I'm actually going to go lower than that, reason being because of that debt load. So, it's a large bank. How much can banks actually grow at the end of the day when they're that big? So what I'm going to do is I'm going to use a 10% growth rate. So here you see it's a 10% growth rate over 10 years. Then we have the terminal stage. It's going to be another 10 years at 4%. And this gives us a target price of $67.85. This is a margin of safety of 39%. 25% is where I like to be. That's great. So here's the thing. We have two very different price targets. We have a $67 price target here and a lot lower one in the price to book model. So let's take an average of these and let's see what that looks like. So here it is. This is my target price for Bank of America. So we have 50% weighting in our discounted earnings per share. $68 was our price target there. And then we have 50% in the price to book valuation, so $38 was that one. Now, of course, these are very different numbers, so what we do is we just take an average, kind of split them in the middle, and this gives us a $53 price target for Bank of America. So if Bank of America was to hit this price target, by the end of the year, let's say, that would be a almost 30% rate of return. So, of course, that would be a great rate of return. So that's a price target. Let's take a look at some technicals. So have a little chart. This goes back until about the end of the year in 2019. And we could see that I'm going to throw on some drawings here. It's kind of overwhelming. I put too much here probably. Actually, wait, let's start with volume, or not volume. Let's start with the moving averages. So here we have the moving averages. It is now trading below the 50-day moving average. So a positive thing is that it's well above the 200-day moving average, which there's quite a few stocks I've looked at recently that are actually below both the 200 and 50-day. And the 50-day is above the 200, so that's actually also good. There's no death cross or anything like that. So let's take a look now. Let's throw on some of the drawings. You're going to see a lot going on here, and I'm going to zoom in real quick. Okay, let's break this down. First off, I'm going to probably remove the moving averages to make this a little less crazy. Remember, this is where it's trading now. Here's the 50-day moving average, that blue line. So let's turn this thing off, and we have an uptrend channel that was going on for quite a bit of time, November of 2020 until about February of 2022 actually. And then of course, like many stocks around that time period, this company fell down through its uptrend line, and now it's in a downtrend channel. So it was in an uptrend channel, now it's in a downtrend channel. So what are we looking at now? We're looking at some support and resistance areas. Pretty simple stuff on this one. Let me zoom in a little closer now to see some of the support and resistance. So first we have this little red line here. This is some resistance that I'm seeing going back for a few months. And then we have some support again going back a few months. So what do I see? So it's in this downtrend, and this little area right here is potential consolidation. Now what needs to happen is it needs to either break up through this downtrend line here, or it needs to bounce off of this support area. So those are two things that you would want to see going on in maybe the next, let's say, like 2 months. Now, if that doesn't happen, this could go down, break down through, stay in the uptrend line, stay in the downtrend line, and break down through the support. And if that happens, then you have a potential of, let's say, a $36 price target here, which would be another resistance I see. Or if it breaks down through that, it could hit 31.60. That's a 22% decline. So these are two areas that I would watch out for. Now, of course, it can stay in this consolidation area and just trade out of this downtrend. And if this happened, it'd be in this kind of like yellow box, and this would be between, let's say, 43 and about 38. Or it can break up through this downtrend line, break up through the resistance. If this happens, then we have a $47 price target here, which there's some resistance there. And then if it breaks up through that, we got some $50 is the next kind of area. That would be a 24% rate of return. Now, all of these are lower than my current price target of $53. So, this is what it looks like. This is where I had the price target. So this would essentially need to get up through a resistance here, a resistance here, a resistance here. It would also have to get through the 50-day moving average as maybe potential resistance. If it got through all of that, of course, you'd want to see, there would definitely need probably to be some volume, or this is going to happen over kind of a long-term period of time. So that's it. So that's what we got. MACD and RSI. I don't see much going on here. MACD is pretty negative. It's got a oscillator that's growing slightly. If you look here at RSI, it's been in decline over the past month, 2 months. So declining RSI, declining MACD, nothing positive in those. So as per usual, if I'm a long-term investor, I'm totally fine just dollar cost averaging into the stock if I think it's undervalued. If I want to time entry points because I think it's going to potentially go down further, then I'm looking to see what happens at this little area here, this resistance area, and if it breaks out of this downtrend channel. Another thing I might do is say if it gets close to the bottom of the channel, that could be a good buying opportunity, or of course if it just bounces off that support area, could be a good potential opportunity. So that's all I have for this video. I hope you enjoyed it. Please hit the like button if you did. Subscribe to see more videos like this. And I got another video coming up on the end screen right now.